Well, I want to thank everyone for coming today and hearing these amazing pitches. It's not easy to come up here, as many of you know, and stand in this room. So well done. We wanted to give founders and community members alike the opportunity to hear from investors and their side of the process. So the idea for this panel is to get family office representatives, regional funds as the Bulldog Angel Network, and South Mississippi Angel Network and North Mississippi Angel Network, as well as regional members like the Idea Village and Lagniappe Angel Network up here to talk about how we collaborate together, how we build a foundation for Mississippi's ecosystem, and how we invest in companies. So with that, I'm just going to introduce myself. If you don't know me, I'm Lindsey Benefield. Me and my husband boomeranged back to Mississippi 2 years ago. I've been the investment manager ever since. Tony talked about this earlier, but I manage the Mississippi Seed Fund, the Investor Network, and soon to be SSBCI. With that, I'm going to go ahead and let each panelist introduce themselves briefly, and then we'll ask questions.
Great. Well, my name is Payne. I'm honored to be here. Thanks for asking me. I am the CEO of the Payne Companies, which is a family office. We're headquartered in Hattiesburg. Prior to that, we primarily owned and operated home health and hospice businesses, and I would say I've had 2 very successful exits in that world. And so we've started a family office to do a lot of this type of investing, and then we have kind of our operating company family office to do kind of our traditional type of investing. And so I think we're doing a lot of different things. And I'm also currently honored to be in the Young Presidents Organization. So that's an organization that you might look up. Those are people that are presidents of companies of a certain size under a certain age. And so I'm the chapter chair of the largest YPO organization in the world, which is basically runs from Mississippi to Virginia, the Southern 7 chapter. Thanks for having me.
Hi, everybody. My name is John Atkinson. I'm the CEO of the Idea Village, which is a nonprofit accelerator program located in New Orleans. I'm also the fund administrator for a group called Lagniappe Angels, also based in New Orleans. You're going to hear a little bit more from me tomorrow on the Idea Village side. So today I'm going to focus with my Lagniappe Angels hat on. That is a small committed capital angel fund that invests in local startups around the region. We've deployed over $540,000 to date from 14 members across that group. It was one of the first angel funds to really form out of New Orleans, and so I have some experience at the early stages of putting that process together and also building up a pipeline of companies for that type of investment. On the Idea Village side, we run a high growth focused accelerator program called VillageX and an early stage accelerator called Idea Institute that supports founders across their phases of development. So also very honored to be here and excited to talk with all of you today.
Thank you. My name is Steve Mercil, and I'm a fund manager and a specialist in forming funds for the Appalachian Investors Alliance. And we specialize in the Appalachian region. However, we have funds outside the region. Specifically myself, I've been forming angel funds for a long time. I've formed more angel funds than anyone in the country, nearly 50 in 20 some states. I formed my first fund in 1998. I'm also a general partner in a small buyout fund that's fully invested. We're actually liquidating the last of our portfolio right now. And we have 2 funds in Mississippi that we work with, North and South Mississippi Angel Funds. And so we're very interested in looking at the deals we're seeing today and working with the entrepreneurs down here.
Thank you, Lindsey. I'm Bruce Deere. For about the last 15 years, I've been a telecommunications executive. The last 15 years or so, I've worked with several startups, mostly in the telecommunications space, to successful exits. I'm currently, I call it the accidental CEO of a manufacturing facility here in town that makes specialty communications cables. I say accidental in the fact that I was consulting them on how to take a established business and try to get it to really grow and double or triple its revenue treating it more like a startup, which is then I got suckered into doing my own advice with that. And I'm also a member of the Bulldog Angel Network, which is a network, not a fund, where we have numerous investments in various companies that are related to Mississippi State in some shape or form, whether that's alumni from the university or working something at the university. It just has to be some tangential connection to the university.
All right, thanks. So as you can see, we have a diverse kind of investor group here. So I'm going to ask the question that probably every entrepreneur wants to know. What do you look for in entrepreneurs?
Maybe sitting next to you, I'm gonna have to go first every time. I don't know. Maybe you go.
Switch it up.
No, yeah. So, no, I think entrepreneurs are exciting, and so what we're looking for are entrepreneurs that are passionate about what they do, that feel like they've got a great service, product, category, but that aren't too hard-headed that they won't pivot. Because we've never been involved in a company that did not have to make at least one material pivot in what they were doing to find success. And so, but passion and work ethic and the ability to learn and seek out learning opportunities and the ability to pivot.
I think pivoting is great. Does anyone have any more to add about coachability or pivoting?
I would double down on the coachability comment. So we talk a lot about product, team, traction, market, and coachability. If you can get all 5 of those things right, you're generally an investable company. We look for extreme strength in 1 or 2 of those areas and the ability to develop the remaining ones, because almost no company that walks through your door is going to have all 5 perfectly right up front. I think the key thing about coachability is it is a spectrum, and the best founders that I've worked with are both highly coachable, but also know what their sort of stick in the ground is. They take feedback well, they internalize that feedback, and they come back with conviction, right? And if you can see that pattern over and over again, that somebody's listening to those around them, but also listening to the market itself, and internalizing that and building that and baking it into the business, it can be really powerful, and that's how successful businesses get built over time.
I'd sort of echo the same things. I describe it as having self-awareness and the confidence to understand what you're good at and not so good at, and having the ability to really empower others to enhance what you're not so good at. And if you can do that, you can build a pretty good team.
Yeah, and to amplify on what Steve just said, I think entrepreneurs that recognize that they may have a really good strength, but there's also some weaknesses either in them or the team, are willing to either reach out and hire, bring on board people that will complement them in the business, because almost any founder of a company will have a really deep strength in something, but they almost never, because they're usually very young, they almost never have that breadth of expertise, and you've got to get the rest of that expertise on your team, which is maybe related to the coachability, but they have to recognize that they have some limitations and then how to adjust and get some team to complement them on that.
So you found a company, let's say, that you can pivot and coach. When do you decide to actually start investing in that company?
I'll go ahead and start.
Okay.
So for our groups, we use a very specific and focused process to invest. So it starts out with getting some initial information that we require. We'll review that with what we call a screening committee or executive committee. And what we're looking for is really, are there any fatal flaws where we wouldn't be interested? Is it something we think our members in our group would really be interested in? Can they get through due diligence? If we, so it's a high level focus. And then after that, we will do some due diligence light. And if they pass that, then we would have them present to our group. And if our group likes them, they'd move into final due diligence. And in final due diligence, we would negotiate a term sheet. We expect and try to drive that process in 60 days or 60 to 90 days. But we won't invest without our due diligence complete and a negotiated term sheet. So it's a deliberative, disciplined process for good reason.
And every investor needs, a pipeline of companies that are either coming up or are ripe for investing. So what kind of work goes into creating that pipeline and maybe even mentoring companies that aren't quite ready?
So I feel like that question is directed at me because
Sure.
we do a lot of mentoring. So I sit on both sides of this divide. On the one side, I sit on the investor side. On the other side, we really are very deeply enmeshed as an accelerator with our founders, trying to help them get investment. And so I'll answer a little bit of the last question and then the second question as well, which is we have a bit of a countercultural view to the when should you make an investment? So when or trigger that I'm investing in this company. When I'm coaching investors, I talk a lot about everything that you need to know to want to invest in this company should really be in the pitch. If you don't walk away from the pitch as an investor saying, hey, this is the most amazing thing ever, and I want to put money behind it, you're not going to talk yourself into it in the due diligence process. And I've seen lots of people really sort of fail on that front, where they try to talk themselves in over an extended due diligence process, and that leads to both bad outcomes for founders and for investors. And so if you flip that around, when you're coaching founders, you've got to get everything in that 7 minutes or that 9 minutes, where you're both attacking a niche market in a way that feels reasonable and accessible, and that you're actually going to get there and you're going to get to the finish line. But then you're also taking me to the moon and showing me how this niche market's going to grow into something mainstream that can become a $100 million business. Because if it can't become a $100 million business, you're going to have a really hard time attracting investment. And so you've got to paint that picture on both sides. And so that's getting folks to understand that, I think, is really the key to mentorship, and surrounding them with the right people who can say it in different ways so that it actually it gets through at the end of the day and becomes something that the founder can incorporate.
Just to echo that, I actually agree with what you say about that pitch, but one of the reasons we have our process is a lot of people are not quite ready to make the pitch the way you talk about it. And so one of the reasons we do what we call a quick look or due diligence light is to identify those things that then we can talk to the entrepreneur about and say, if you're going to get through this process, these are the things you've got to address and you got to shore up. And then one thing that's a little different about our funds in general is they have a very wide aperture. So even though they're looking for high growth opportunities, they'll also do some things that are lower growth, even Main Street businesses. We've done hotels, we've done restaurants. They've all made money because there's a way to structure and price those deals too. So our aperture for our funds can be fairly broad, depending on the fund and what they're looking for and what their returns expectations are and how they want to serve their regions.
Yeah, I could add that from, like in my case, investing through the Bulldog Angel Network or myself personally, I agree with the point of if I'm not excited about it when I first hear about them, I'm usually I'm ready to step back and do something else because it's just not worth the effort to get me over that hurdle, which is one of the reasons in my case and stuff where the network approach is really nice. If I look at the Bulldog Angel Network, there are numerous investments. You don't have to get 60 or a super majority of the investors to agree. You just got to get enough that are in the group to decide they want to roll into that one. So in that case, it gives the individual investors the opportunity to say, I'm not too much into a app-only market that may be $1 billion or it may be a complete bust. I'm more interested in Y and Z. And then it lets us, kind of go through this issue, then jump into where does the due diligence go and the other opportunities there. So it lets you get that. I will add, my take is that entrepreneur in residence, some for Innovate Mississippi, I tell the founders when they've got a pitch, it may be 7 minutes, maybe 10 minutes. You got about 90 seconds to get the hook in. I'll give you a quick story. I won't go on about it, Lindsey, but I was out pitching on the West Coast on Sand Hill Road, And we went into one of the larger VC firms. 2 minutes, at max, 2 minutes, the partner which we had set the meeting up through a mutual partner that we had, got up and looked at a couple of the associates and said, okay, you guys carry on. We did. We carried on with full vigor trying to go through the pitch, but I'm sitting there going, this was probably going to be an hour wasted time. We get to the end. They asked a lot of questions, the associates, not the partner, because the partner left and the other senior level guy left. I said, okay, so where do we stand? He goes, oh, no, you're good. He was very interested. That was his cue to me to keep going on. Otherwise, we'd have been through in about 10 minutes. So the main partner who was going to ultimately invest or kind of make the decision, it literally 2 minutes and he was out of the room. So I can't stress enough that to the founders, or if you're making the pitch, you got that 2 minutes sometimes. It literally is that short to get your message across.
That's a really great story. You got to kind of say where you've been, where you are, and where you're going,
Yeah.
and get that right up front. Thanks, Bruce. Okay, so let's talk about style of investing. I think Mississippi has its own kind of style to investing. The ecosystem's a little smaller. It's growing fast, but it's growing. And I just kind of want to hear about your style, how you think Mississippi impacts your investment strategy, or even the deals that you see, and just kind of share that.
Yeah, I am from Mississippi, so I think, and very proudly so. I think Mississippi's a hidden gem. I think there's a lot of talented people here that Mississippi, and I mean this with all due respect to the state, but it doesn't teach all of us how to become what we can become. And so I think there are a lot of hidden gems in the state. There are a lot of hardworking people that are willing to do it. So we're a member of the South Mississippi Angel Network purely to meet people like that. And it creates a new bucket of investment opportunity for us that we probably don't have enough bandwidth to see as much as an angel network can show us. But I look at Mississippi as a real, hidden opportunity, and I'm happy to keep it hidden since we're now investing in the state. So,
Yeah, I can add that when I first got out of working in the corporate world and working with startups and on that side of it, it was hard to raise any funds in Mississippi. If you said, hey, I need this and this, you just could not get there. Or 15 years ago, it was very hard to get there. So the infrastructure of the investment world is much better now than it was. We still don't really have the same level of investment money that maybe you see out on the West Coast or other places, but we're getting a lot closer with that. And one of my hopes is as we're continuing to go forward, we get more groups that can do more money. So we don't see some of the more promising companies wind up going to an accelerator out on the West Coast, that they can stay here closer to home, not opposed to New Orleans either, but it's a long track from here to the West Coast, whereas at least if we can keep it in the region, that's quite helpful. And I think we're getting better at that. We still have some work to do.
Yeah, I don't live in Mississippi, but I do spend a fair amount of time here and find myself spending more time on the business front. And I see a lot of similarities between Louisiana and Mississippi and sort of the path that we've been on. We've been very fortunate in New Orleans. We've had over $2.5 billion in exits in the last 18 months. So we're like finding ourselves on the map and more part of the conversation every day, which is really exciting, but it's taken 20 years to get to that point. And so it takes a sort of sustained effort. And I think, I've been doing this about 15 years now. And in the early days of trying to raise funds in New Orleans, it was a big deal if you raised $250,000, right? $500,000. That was a large round. Now we're starting to see more million plus rounds. That's becoming more of a regularity. And so that's really exciting. And I think part of my approach and my thinking is we have to start building more of a regional coalition to try to bring those resources here as opposed to having our companies go to the outside. And so that's a big part of why I'm here and why. What I've been saying in Louisiana, I'll see if this works here, is if you know what a crawfish is and you're doing innovation, you should be in our market. So we should all build the Crawfish Coalition and go beat some West Coast companies or maybe some Atlanta companies while we're at it.
I think that's a really good point. From what I've noticed the last 2 years being here in the ecosystem is that there's a lot of eyes on the South for investment. Nashville's blowing up, Atlanta, of course. But there's a lot of opportunity here in Mississippi that a lot of the national investors are looking at. And I get phone calls and emails and they say, how do I get a deal in Mississippi? So there's a lot of eyes on us.
Can I add one thing to that?
Yeah.
I've also seen very household names that were some of the richest people in the world who are hiring super sharp Mississippians to plug into their network, looking for operating Mississippi businesses to come by and roll up. Mm-hmm. And so I've seen that in 3 different billionaire families in the last 6 months.
That's great.
I want to talk this kind of gets in the whole ecosystem discussion. So when I did my first angel fund, it was in Minnesota, and it was back in 1998. And I remember doing this deal, and I was talking to a small venture fund in Minneapolis, and they were telling me that they really liked this deal, but they weren't going to invest in the deal because it was too far. It was like 2.5 hours from Minneapolis. And this VC guy was going to fly out to Silicon Valley that weekend to look at deals there. 10 years later, that company had a 10 times return, and that VC was broke. And the point to me is always that I've been a believer in a long time that there's really talented people everywhere, and there's capital available, but it wasn't organized. And so the value of the kinds of organizations here, Innovate Mississippi, and the people that are up at the stage is you're creating this ecosystem. And what we are learning to do, and what we've learned to do, I think, is that if entrepreneurs understand what investors need, they start to think about how they can grow their company and the kind of talent they need in that company different ways. And so then the deal flow improves. Vice versa, the investors understand how to communicate to the entrepreneurs and where they can refer them to places like yours and Innovate Mississippi and other organizations that can help them put the human resources around them and the strategies around them so they become investable deals. And that catches people's eyes. And we know this works because in the last 3 years, our network of funds have invested through the individuals and the funds, $20 million in 68 companies, and we've raised another almost $600 million of outside money for those companies. And so we know it works. They've created over 600 jobs. And it's because the infrastructure of people that are working with entrepreneurs and the entrepreneurs themselves are starting to understand what it takes to be successful in this environment. And we're able to take these networks, and the small Mississippi can act really big. And that's the point of what we're doing and why we do it.
And I would add to that, for the founders in the room, one of the best ways to think about raising capital is to know the people who are going to write those checks before you ever have to ask for money. And I think that's an area where places like this can really excel, because we talk a lot in New Orleans as a 2 degree of separation community. You're within 2 degrees of separation of anyone that you need to know. And so that actually becomes a really strong attribute when you start thinking about how fundraising gets done, and you put that hat on of building those relationships before you need something. That can become really powerful.
I do think that's a hidden gem in Mississippi, and one that I've learned quickly is it's 2 degrees of separation. Everybody knows somebody that you know. So Steve, I'm going to direct this question to you since you've had over 50 angel funds developed. What attracts you to early stage companies?
It's just a thrill of taking people that have a vision and an idea and helping them succeed. Because my favorite thing to do is to walk through a company where people are really making good money and they have benefits and they're being able to take care of their children, and they're generating their own ideas for the next company.
Anybody else want to talk about the different stages that you invest in and what's the difference for you? What do you like investing in?
I mean, to answer that specific question, from my seat, I mean, the upside of an early stage company is super appealing. I mean, what can you do with kind of an infant business, put them into your network or skill set, and then really make them kind of boom? And so in our world, we're looking at kind of buckets of cash flow. So, you know, you have your singles, and here's like the real estate traditional deal, and it's collateralizable, you know, all that. And you're just kind of moving up the chain. And so how can you move one that's kind of at an infancy up to this really high growth, pretty quick company? That's exciting.
So plugging in your knowledge and experience and seeing how it grows.
Yeah.
Well, most of the investors that I know are very excited and motivated by being able to say they were there when, right? So you were able to have a meaningful impact at the inflection point of this company. I also find in talking to people that are new to angel investing, after they've done it a few years, they're often surprised about how educational it is. It's one of the best ways to see across a variety of companies, be able to start to see patterns. And so the value of that education is really extreme and gives a perspective that can help bridge across companies.
Yeah, from my perspective, one of the things that when I'm personally looking at it, whether it's in a fund or within a network, I like it from two aspects. One, the investor, but also can I actually contribute to the startup? Can I take my years of expertise and add a little bit of nugget of information to them that maybe keeps them from going down a path that would not have been as well, because they definitely will pivot. I've been working with a couple now that third and a half pivot, but I think it's actually now we're getting there. And there's the things that I enjoy, both from the investment standpoint, because at some point maybe there's a payout, but even if it doesn't get to that ultimate payout, there's from the mentoring standpoint that I think it's helpful to me, just gives me the gratification, as well as I think it helps maybe Mississippi as a whole, because we can get some of these companies to actually get over the hurdle. Because as you can imagine, startups, if you're a founder or an entrepreneur, you can't afford to pay, big fees for somebody to come in and help. And I think that's important too, that when the investors are investing, that hopefully out of that group, whether it's a fund or a network, there's a couple of the people that are going to also spend a little bit of time mentoring and moving it along in the right direction, not just throw their money at it. Now, it's not all being philanthropic. I mean, if I'm putting some of my money in it, I'm trying to help protect that investment also, which kind of goes back to the coachable. There's been a couple of things, companies where I've looked at it and gone, this sounds really great, but I just don't know that founder is going to be that open to some of the direction. And then, you kind of step back because you're like, I don't want to beat my head against a wall with the founder or the entrepreneurial team if they're not going to be willing to adjust enough.
I think that goes back to what John was saying about knowing the investor before you need the money.
Yeah.
It's important to kind of go a step above where you are. So if you're early stage, getting to know those VCs, so they can mentor you a little bit along and create that relationship before they invest. Okay, so we've talked about how to get to yes. What about the no's? How do you break it to founders or relationships that you've created when they come to you looking for investment?
Well, there is no easy way. And I find the best way is just to be honest and open and frank, actually. And then what we try to do is make sure that we have some place where we maybe can refer them to where they can work on their business, or maybe they can get funding in a different way because it's a different type of investment, or there's other programs out there. But best way for us, we if we say no, we try to call them up quickly as soon as we know we're at a no, and walk them through the reasons and give them advice on what they could do next or where they could go next.
Yeah, I would like to add to that, in addition to being forthright and frank with them, it's timely. I mean, if you're not liking the pitch, if you think they need to do something, tell them now. I mean, maybe that day, but be quick about it. Don't let them hang out there, because the entrepreneur gets, you don't want them investing a lot of time trying to work with you when you really know it's not for you or not for your group. So let them move on quickly. And then to that point, maybe help them go to the person that may be interested in what they're doing.
Some of my best investments I've said no to 4 times before I actually said yes. So I never really view it as the end of the road. It's no, not right now, right? And it's, but that actually does mean no. Some founders misinterpret that, and sometimes you're trying to give feedback and be helpful and make referrals, and folks misinterpret that as, you want to keep the conversation going. That's not necessarily helpful, but folks that take the no, take the feedback, go work on that for some period of time and then come back, that's actually a fairly strong signal that says a lot, particularly if that business has made meaningful progress. And so it's no, not now. And the other thing that I really try to make a point of is if the founder has invested in the process with us, we try to invest in the process with them. And this is something I make my team do now. I'm not doing as much as I used to personally, but it is pick up the phone and call to say no. And so once folks get past a certain phase in our process, we try to make sure that we're having a conversation with them on the backside too.
That's a good point. I require that we have a discussion with it. So even if we're going to do a quick no after a meeting, I'll usually tell them in the meeting, we're going to make a decision and I'll get back to you tonight or tomorrow morning, and I may not be able to get a hold of them. So I might leave a message, but I'm going to follow up and make sure I have a direct conversation with them.
So what does the process look like for Bulldog or Lanyap or even App? How long is the process? Is it 2 months? Is it longer to go through and pitch and do the due diligence?
I mean, for the Bulldog Angel Network, it's pretty much like Steve said. I mean, so Wade Patterson, who's kind of the president of the network, he works with them and mentors them along to get it to something that the rest of the network is willing to, or he thinks is willing to look at. From the point they make a pitch, it's usually, well, let me just go back. They'll make the pitch, then within a few days, there's a request for the investors of who's interested and for how much. It's not binding because there's no due diligence yet. But then that gives us a idea within a week or so, are we going to reach the threshold of the minimum raise that they need? Then we go into a due diligence. Now, usually that's a 30, 60 day, we'll call it 60. I don't know that it's ever really 30. Sometimes it's longer because you wind up with issues showing up in the due diligence, whether it's their legal documents are not correct or something's going on. But we'll say a nominal 60 to 90 days. Then it's just once we get past the due diligence, it's the formal documents with a final agreement on the term sheet. We've already had a term sheet when they made their first pitch, or at least a draft. Now, it gets changed sometimes as we're going back and forth. And then it gets into the funding with it. Sometimes the network will, depending on the size, I'm trying to think about the ones I've gotten in with it. Most of them we usually wind up asking for a board seat, so there is some direct feedback to the company from the investments that came through the network.
I mentioned our process before. It's similar, but we target to try to get to a signed term sheet within 60 to 90 days from the time we have what we call a completed business summary and related docs. So we are setting up our websites now where you're asked as an entrepreneur to complete certain things, and that's because we want to get you through the screening and the quick due diligence pretty fast, so that when you present, we're thinking that you're going to be able to get through due diligence. Once we get through due diligence and sign a term sheet, that's that 90-day period. It's going to take some other time to actually get the documents done and closed. What slows up the process usually is the entrepreneurs. It's not usually the investors. It's, you know, they're busy, things happen, they can't get you something, you know, or you find something that's kind of unique and you've got to figure out how to resolve that. But it's usually not the investors that are slowing the process up.
Yeah, I spend a lot of time translating between these two things. So most investors who run a tight process will tell you 2 to 3 months, right? Which is actually the cycle time if everything goes according to plan. And that's great. From a founder's perspective, you really need to plan for 4 to 6 months. If your cash runs out less than 6 months from now, it's already too late to start fundraising, because there's time from sort of initial contact to getting meetings set up to the sort of pre-vetting process to passing documents back and forth, and the clock sort of stops each time those things happen. So from, you know, best case scenario of initial contact to check, everything working as it should is probably about a 4-month process.
That's right, yeah, that's a good point.
Yeah, and you need to pay attention as much as they might not think about it, is as we're coming up on the holiday periods, it's just difficult to get things to move from Thanksgiving through the first of the year. And then sometimes in August too. So you usually have to kind of look at the calendar as to where you are in the year.
And if you need money tomorrow, don't bother with groups. It's got to be individuals who can make decisions on the spot.
Okay, I'm going to open up to Q&A, but I have one question I feel is important, especially with the title of the conference. But Ab, I'll ask you this first. How do you work with and invest alongside other Mississippi investors?
Well, one, before the Q&A, I would also stress to burgeoning entrepreneurs or investors or whatever. I was going to say this before you asked the question, so it's makes sense. The network is so important. I don't think you can over network yourself, because if I don't know you but I know someone else that does and trusts you, then I'm more likely to hear your pitch. Please be kind of respectful of that, and then try to figure out a way to make it work. So I think, but to invest with other Mississippi entrepreneurs, I mean, there is a network that exists, and whether it's in my world and it's called YPO, or it's in someone else's world and it's called something else. If something sounds really good, but we don't understand it, we'll call 3 other potential family offices that are local and get them to hear the pitch with us. And so there's more of that now, and there's a network in the Southeast really that we're running across a lot, where we're one of 6 mid $500,000 investors for pitches.
So you invest together and all
You invest
diversify
together
a little
because
bit?
no one wants to take this catastrophic risk
Right.
alone. And but no one wants to, maybe it's the wrong answer, but no one wants $4,700,000 investors either sometimes. So, there's a network that gets created just from that.
Yeah,
So it's,
great.
I think we co-invest in syndicate deals all the time. It's important. I think our diligence stands up and our pricing stands up, so that's attractive to other groups. And we share our information with other groups. We sign a treaty if we don't know the group, but if they're in a network, we trade information with Bulldog Group all the time, for instance. And so we're trying to co-invest. You can never have enough good investors in a deal, and it helps with the expertise. And then we work to bundle that up so that we can do these closings, and you're not waiting for a close to happen. You can have multiple closes and things like that. And so syndication is really, really important, and I think most organized groups do quite a bit of that.
Awesome. And I think that's such a good point, and maybe hopefully a good time to open it up for Q&A for anyone who has some questions. Yes.
So what are some of your flagship investments that you've made? Maybe you're most proud of the companies that you've seen go from start to exit, biggest investments?
well, I'll go. We did one in September of 2018. It was a business that we really understood well. It was a home health and private duty business in Tennessee that was super distressed. Government in the building, corporate integrity agreement. Our team came in, turned it around, got it running really good, and out of nowhere, a division of Walgreens showed up and bought it from us for a lot of money and sold. This never happens, but at 4 p.m. on December 31st, 2020.
There's a great YouTube video of Ron Conway, who's a very famous Silicon Valley investor, getting asked that question by Sam Altman, who runs Y Combinator in one of his classes at Stanford. He just sits deadpan in front of the mic and says, Google.
Yeah.
So I wish I could say Google. So I'll give you one of my anti-portfolio, which is the company we passed on because we weren't smart enough to invest in, and then one that we did invest in. So we are the group that I helped form, looked at Waiter in its like very earliest days as it was coming out of the startup weekend process, which would have been an amazing investment since they've subsequently done a SPAC and become a public company. One that we did invest in, we invested in a test prep company out of Baton Rouge that was started by somebody who got a perfect score on the ACT and wanted to use that to help sort of pay it forward for others, and particularly focused on a segment of the market that no one else focuses on, which is the sort of middle of the market where the difference between and I don't exactly know the scale for ACT, but a 21 and a 23 means the difference between a top scholarship and not going to college. And so he has built that company into a very successful business. And is the one founder I've ever worked with who actually hits his financial projections, which is also pretty incredible.
I'll talk about one that it wouldn't be a household name or anything, but the point is what the founder did to set the table for a strategic acquisition. So this was a company that made dumbbell smart in processing plants, primarily liquid processing plants. So any kind of food liquid kind of thing, or also chemicals. And he sold to larger companies, and they used technology off the shelf, and they also had proprietary technologies. So they were essentially putting brains on valves and making them smart. And what he did is he had a strategic planning session with his top management every 12 to 18 months. And what he would do is he would invite his list of 5 companies that he thought would be the most likely people to be interested in acquiring them. He'd invite their CEOs to come in for a half day and talk about the industry as part of his strategic planning. And by doing that, they got to know him, and of course, he got to know where they were all going. And about 3 or 4 years after we made the investment, I want to buy you from one of those. And I think the lesson is that as founders, you need to be thinking about not just who might buy you, but what you might do in order to position yourself to be noticed by those folks so that when the opportunity comes, it's in your favor.
That's really tough to convince your team too how important that is, because they are in the weeds of their job. And so it's hard to run a company, not that you're looking to sell, you're not, but you're looking to make yourself look as good to sell if someone knocks on the door.
Yep.
Yeah, it's difficult for them to keep their eye, because you've got to keep your eye on 2 balls there. One, running the company and getting it to hitting financials, doing what it needs to do. At the same time, when you're looking at, okay, where is my exit or roll up, getting your eye on that ball. And that is a very difficult thing for most of them to do. It's difficult for any company to do. With experienced executives, much less companies that have founders. That's the part that where it's really that transition gets to be very difficult for them.
Great question. Yes, go ahead.
All of you said that, when you give your no's, you want to give them the why. And you also said coachability and being able to pivot, and self-awareness is so important. So when your no is based on their lack of coachability and self-awareness, what's the advice you give them to handle that?
Well, probably for me, it's going to be a discussion about the overall management team, and we would probably say we think your management team isn't mature enough at this point in time, and so you might consider talking to some other people that have some experience and bringing them in, and also maybe filling out your your board or advisories. The thing about board and advisors is we want board and advisors that are actually paying attention, not just showing up at board meetings for an hour and not asking any hard questions or really helping the company. So that's usually how I would have the conversation.
There's always someone in the network who's even more hard-headed. And
Yeah.
sometimes the answer is go talk to that person and have them sort of really break down the business. And that's often a way to get through to somebody who is not on the surface coachable.
I could tell you the story about a company I invested in where the founder turned out to be a psychotic. And I had so much trouble with the management team, I hired an industrial psychologist to do a measurement. It was not a deal I wanted to do, but this angel group wanted to do it. And this psychologist calls me up one day and says, well, the good news is half your management team is really good, but the founder is borderline psychotic. So it took a while to kind of maneuver that situation into a good situation.
Okay, well, it's about to beat, but I know Sajani has a question, so real quick.
Yeah, hi. Someone made a comment, I think it was John, about, you're looking at 100 million revenue typically. What type of timelines are you looking at, and are you looking at that different for a digital, app versus a
Yeah, great question. So we talked a little bit about exits here at the end, and I think that's a really important point to double click on, because there are other answers to this question, but my answer is if you're taking outside investor equity from the type of folks that I deal with on a day-to-day basis, you're implying that you're going to sell the company, right? And whether you say that or not up front, or it's part of the plan up front or not, that is the most likely outcome. It tends to either be that or IPO. And in Louisiana, we have two public companies, and they're both utilities. So IPO is not a path we see a lot of. So that means you're going to sell. So when we talk about a $100 million business, that's a $100 million exit price, not necessarily $100 million in revenue. Seen companies get a $100 million exit price on $10 million in revenue. Mm-hmm. The key is you've got to paint a path between here and there, and it's got to be believable. I think timeline matters less. Most founders will say, I'm getting there in 3 to 5 years, and most investors in their head are saying that's 7 to 10 or maybe 15, and they're probably okay with that. There's a little variance in that depending on where the investor is in their fund life cycle. So if you're on the tail end of that, they tend to really start looking for shorter deals. But I would say most investors have an 8 to 10 year sort of general time horizon.
Just to follow up to that, I like to keep it simple because everyone gets all hung up on all this stuff. And I kind of tell entrepreneurs, build a really good company that's growing and profitable, and we will all be able to have an exit that we're happy with. And I think there's a tendency that, you hear the number, right? And so then you start to project things that probably aren't realistic. And investors see that all the time.
Yeah.
And just be realistic in what it's going to take and what the milestones are, and be disciplined. And if you get your company on a growth cycle and it's profitable, you're going to be able to have opportunities to sell.
Yeah. If your goal is a $100 million exit, you probably shouldn't be fundraising at a $50 million valuation, right? Because that means your investors are only getting 2 times their money back. But at a $2 or $3 million valuation, that's a great deal. So it's also balancing the terms of the deal with what the founder's ultimate ambition is.
Okay, great questions, thank you. And thank you all for being here again. We're gonna have a break, and then at 4:05, we're gonna come back and hear John Welch with Connect V&A. Thank you guys so much.